Good evening, my host.
Yeah, Prof, good evening. We can hear you loud and clear. You're welcome, sir.
Good evening, sir.
All right.
I think we should get some minutes for students to join. I will just, I think 5.
Yeah, I can start exactly now. Thank you.
All right. Okay, sir.
Okay. Is he hearing me?
All right. Good evening, everyone. I want to welcome us once again to our SX5 class on Zoom at First Stress Accurate Success Link. I want to believe we are all much ready for the class today. Like I always tell you, I want to believe you have your pen with you, and likewise you have your jotter with you, because there might be need for you to jot some points that might not be included in this material and are very, very important for your understanding of the topic at hand. Okay, so if you have not gotten them, can they get them ready so that we can have each free class? We are still on business valuation. And so far so good. We have been able to cover 3 approaches to business valuation vis-a-vis the asset-based approach, the market-based approach, the income-based approach, which is popularly known as the dividend valuation model. The fourth one is what we are on presently, which is our free cash flow model. We started the free cash flow model yesterday, and we were able to cover the meaning of free cash flow, the computation of dividend capacity, the format for computing free cash flow to, okay, we look at the classification of free cash flow where I told you that we have two types of free cash flow, that we have the free cash flow to the firm and the free cash flow to equity, where I told you that the free cash flow to the firm is that free cash flow that is available for distribution to both categories of provider of finance in the organization. And these two categories are what? They are the debt holders and the equity holders. So free cash flow to firm is available for distribution to both equity and debt holders. We also look at free cash flow to equity. And we said the free cash flow to equity is the free cash flow that is available for distribution to only equity holders. And we went ahead and looked at the format for free cash flow to the firm. We went ahead as well to look at the format for free cash flow to equity. And I was able to tell you that we have three items that distinguish free cash flow to equity from free cash flow to the firm. And we identified these items to include: 1, interest; 2, issue of debt capital; and 3, redemption of debt capital. I said these are the three items that differentiate free cash flow to the equity from free cash flow to the firm as a whole. Okay, so we usually look at the format for computing free cash flow to free cash flow to the firm when you are given free cash flow to equity. You are given free cash flow to equity and you have to derive free cash flow to the firm. We look at that format yesterday. And of course, we were able to conclude yesterday's class by looking at example number 1. Example number 1 is on Adeosun Limited. Adeosun Limited. Here is the question we treated yesterday. Adeosun Limited. We have been able to solve that question, and we have been able to look at how we determine the market value of a company's equity using the free cash flow to equity. We demonstrated that yesterday using example number 1. So today we shall progress to the next example on our material. That is session 10. We are on session 10. So if you're on the material, just go to your session 10, question number 2. Session 10, question number 2. That is what we please let us all kindly mute our audios, please, so that we can enjoy the class. Thank you. Okay, example number 2. Example number 2 is on Barcelona PSC. Barcelona PSC. Okay, like I always tell you that before you go and read the body of the question, the first thing you need to do is what? Is to go and read the requirement of the question, because it's the requirement of the question that will give you an insight to what are the items you should be looking for in that question. The moment you see the requirement of the question, of course, the principle will quickly come to it. Okay, this is the principle. Okay, if this is the principle, what are the items required by this principle? Okay, that is why I always encourage my students to go and read the requirement of the question first. Okay, let us go and read the requirement of this question and see what the question wants us to do. Let's read the requirement of the question. You can see that the question is, of course, very large. The question is very, very large. And as large as it is, I want to tell you it's not different from what we did in example 1, as large as you see there. So don't be scared by the magnitude of the question. The magnitude of the question should not scare you away once you understand the principle. Okay, the question says required. Determine the price per share of Madrid PLC using A, free cash flow to equity model, B, free cash flow to the firm model, and C, dividend valuation model. Okay, you can see that we want to compute market value of the company's equity using A, free cash flow to equity, and B, using the free cash flow to the firm, and C. That's just a hard-on question because it's what we have already treated. Yeah, it's what we have already treated. So the dividend valuation model, ordinarily, I can give you as an assignment to go and attempt it. Okay, but don't worry, I'm going to solve it for you. Okay, we're going to do it together right in the class so that you have a better. If you don't understand it before, that should be an opportunity for you to understand. And if you have understood it a little before, this should also be an avenue for you to understand it better. So we are solving everything in that requirement together. So we've seen what we want to do now. Let's go to the body of the question itself. Okay, Barcelona PLC is a company quoted on the Nigerian Stock Exchange several years ago. The company is into the sales of synthetic drugs. It has grown over the years by purchasing smaller business in the same industry. As part of its growth strategy, it is considering the acquisition of Madrid PLC, a company in the same line of business with it. That is just a background information of what Barcelona does, and the intended action it wants to take in order to expand. Okay, your firm, Aesthetic Standard Professional Services. Your firm, Aesthetic Standards Professional Services, ASPS, has been appointed to assist in the determination of the fair price to be paid for 1 share of Madrid PLC. Information relating to Madrid PLC is given below. I believe you are following the question. Please, let us follow the question closely. Statement of financial position. Now we have from 2005 to 2015 to 2018. Okay, we have property, plant, and equipment. The figures are stated in there. We have current asset. We have the figure right in there. Okay, we have our ordinary shares, which is 0.25, that is 25 kobo each. The figures are there, constant anyway. Retained earnings, the figures are equally there. 12% preference shares, we have it right there. 10% bound. Current liabilities. That is the information on our what? Statement of financial position. Now, we are equally given the income statement of this company. What is the income statement like? We have from 2015 to 2018 as well. We have revenue, okay, gross profit, operating expenses, profits before interest and tax. We have our interest, we have profit before tax, we have tax at 30%, profit after tax, preference dividend, then we have profit after tax and preference dividend. Now we equally have additional information. The additional information is what is going to give us what we are going to do to the statement of financial position and the income statement given above. Additional information, we have information 1. The most recent year is 2015. The most recent year is 2015. When we say most recent year, we simply means what? Current year. The current year is, sorry, is 2015? Supposed to be 2018. Okay, the current year 2018. Included in operating expenses. Included in operating expenses are provision for bad debts. We have depreciation. We have loss on sales of assets. Loss on sales of assets. Okay. Information 3. The free cash flow to equity is expected to grow from 2019 to infinity by average growth rate in revenue from 2015 to 2018. Okay, that is the estimated growth rate in what? Free cash flow to equity. That's what is contained in information 3. Okay, information 4. Free cash flow to firm is expected to grow from 2019 to infinity by 4%. Okay, that is the growth rate in free cash flow to the firm. Information 5, the dividend payout ratio is 40%. The dividend of the company is expected to grow from 2019 onward by 17%. Okay, this is our dividend payout ratio, which means the proportion of our current earnings. What I mean by earnings is retained earnings, okay? That is profit after tax and what? And preference dividend. The percentage of that profit we are paying as dividend is what is giving us as 40%. And that is what we call dividend payout ratio. Now that dividend, whatsoever the figure is expected to grow by 17%. Right from 2019 upward, that is to infinity. That's what it means. Okay. Information 6. The gearing ratio of the company by market value is 24% debt, 80% preference shares, and 58% equity. They've given you a gearing ratio. And of course, this one, there's no difficulty in determining. They've given you specifically. Debt is what? Debt is 24%, preference shares is 80%, equity is 58%. That is our gearing ratio. Okay. Yield on preference shares is 11.2%. Yield on preference share is 11.2%. When we say yield, don't be confused. Yield simply means cost of what? The preference shares, okay? Which is stating as what? The rate of that preference dividend. That's what they are referring to here specifically. Okay. Note 9. The company is rated BB+. And the credit spread of BB+ rated companies is 452 basis points to you again, because we've done that in our section 9, I think, when we did the last example. I could remember we discussed yeah, I remember that question where we are asked to determine the implication or the effect of the rights issue shares on the wealth of a shareholders having 3,000 shares who has decided not to take up the rights shares. I could remember that. There I discussed extensively what we mean by credit spread. Okay. Now, that is the question, and we are now asked to compute our free cash flow to the to equity and use it to determine the market value of the company's equity. Okay, to compute free cash flow to equity, I've already told you that free cash flow to equity is that free cash flow that is available to only equity holders. Now, and I told you, when you are given your income statement, okay, when the question has already given you income statement, that is, it's not that you have to go and compute revenue, cost of sales, operating expenses, profit before interest and tax, interest. It's not that you are going to start computing those items. You have already been given a complete income statement, and you have to prepare free cash flow to what? Free cash flow to equity. The simple thing you need to do is to go and pick profit after tax, because it is profit after tax that is available to only equity holders. I believe we are getting it now. It is only profit after tax that is available to only equity holders. So both equity holders, debt holders, and even the government are all together, and even the government. So 3 different claims can be laid on profit before interest and tax. Therefore, if what you are dealing with is free cash flow to equity, the appropriate profit you need to pick from the income statement is a profit after tax. Are we together? That is your starting point. Now, when you pick your profit after tax, you need to go and adjust, because that is profit. Abi, don't forget there is difference between profit and what? And cash flow. Okay, I think I told you that when I was discussing dividend capacity, where I told you that dividend capacity at this level of yours, at the ICANN professional examination level, you are not supposed, except if you are doing normal financial ratio. But if it is on the basis of cash flow, you are not expected to go and compute dividend capacity, which is the same thing as dividend cover. You are not expected to go and compute it based on profit after tax. The reason being that profit after tax is what? Is a figure that can be manipulated, okay? And it equally comprises many items that do not involve movement of cash. I gave you examples of those items yesterday. Why I need to repeat this is because I want you to grab the principle of this. I don't want you to cram any bit of my note, please. You don't need to cram any bit of my note. What I require of you is understanding of the principle. Okay, so profit after tax is inclusive of what? Depreciation that has already been deducted, provision for doubtful debts or whatever provision you have made for that period, impairment of assets is already included, revaluation of assets, either downward or upward revaluation, are already embedded in their profit after tax. So that item is not a cash item. If a company tells you, we made 10 billion profit this year, it does not mean that the company has 10 billion in its bank account. That profit is a paper figure, okay, deal with that 10 million. So what do you need to do? Because what you want to deal with is cash flow. We need to go and adjust that profit for what? For non-cash item that has already been adjusted before arriving at that profit. And because of what you are given here, you need to go back to your income statement and look at What are those items in this income statement? Don't forget, the profit you are picking is what? Is profit after tax. This is the profit I'm picking. Are we together? That is the profit I'm picking. Okay, I will now look at what are the non-cash items that has already been adjusted before arriving at that profit after tax. Okay, these are the items given here. Look at it. We are given under information 2. Look at it here, right there. Under information 2, you are told that included in the operating expenses are provision for bad debt. They are non-cash items. And because the question tells you, don't forget, provision in the income statement can be what? Can be a decrease in provision or an increase in provision. But the moment you expenses, it means it is what? It is an increase in provision. Are we together? If it had been a decrease in provision, it will have been included in what? Other income. Are we together? It will have been included in other income in this income statement. So because this is included in operating expenses, it means these items here, this item here has already been deducted before arriving at that profit after tax. Likewise, we have depreciation that has already been deducted as well before arriving at that profit after tax. What do I need to do? Because they have already been deducted, I will go and add them back. Okay? Non-cash item that was deducted should be added back. Non-cash item that was added before should be what? Should be deducted. You do the opposite to what has actually been done to that item. So because all this here were initially deducted, so what do I need to do? I will need to go and what? Add them back. I believe that is clear. That if you look at the format, I explained the format extensively yesterday. So it is the same format I'm following here. I'm not doing anything other than the format I've given to you. Okay. Now, we equally have what? Okay, this is another item. We have loss on what? Loss on sales of assets. Loss on sales of assets will also be adjusted. It's also a non-cash item. It will have been deducted. So what do? You need to go and add it back. All right. After that, what do you need to go and do? We need to go and sort out our working capital. I believe you can still remember that. And I told you the constituent of working capital. The constituent of working capital are what? The constituent of working capital are your inventory, your trade receivables, your trade payables. And I warn you specifically that whenever you have a short-term loan should never be included as part of your working capital. Okay? Short-term loan should be treated as you treat it as part of your what? As part of your working capital. Okay. So our working capital here obviously will be where do you have that figure there? A statement of financial position. Okay. You can see that the only thing we have here are what? We are just shown our asset, our current asset as what? Just current asset. It was not broken down to either receivable or what? Or inventory. Is lumped up as what? As current asset. Okay. Now, we also have our current liabilities. I mean, we have our current liabilities. Okay, we have our current liabilities. This will be the component of my working capital. Now, let me warn you against this. The examiner might want to play with your intelligence, and they will now tell you in the additional information. It is not in this question. I'm just taking you to another level now. Now, assuming you have been given this, where do we have it? You have been given this current asset. You have been given this current asset, Riem. You have been given this current asset. This is no, this is not a current asset. That's current liability. They have a current asset. Okay. You have been given this current asset right here. Now, don't forget, this current asset can include what? Inventory. It include what? Trade receivables. It include what? It includes your cash. All are what? Current assets. Now, the question will now tell you under additional information that this current asset stated in there in the statement of financial position includes so amount for what? For cash. If that is the case, the amount that is meant for cash must be deducted from that current asset before you go and calculate your changes in working capital. Are we together? Okay. So that's that. That's what I needed to explain to you. So what will I do to that? I'll go and compute my increase in working changes in working capital. So after changes in working capital, I'll go and check whether there's going to be what? Whether there's going to be capital expenditure, or whether a portion of our PPE is going to be sold during that accounting year. It should be what? Added as an inflow. If it is purchased, it will be regarded as capital expenditure and it should be deducted. Are we together? All right. So when we are done with that, because I'm dealing with free cash flow to equity, I will need to go and sort my what? My issue, the proceeds from issue of loan. When you issue additional debt, you collect money. So what has happened? An inflow has occurred. But if you redeem part of your debt obligation, what happened? An outflow has occurred because money has what? Money has gone out. So I will need to go and sort that as well. Okay. After that, what else do I need? That is what will give me my free cash flow to equity. As simple as that. All right. Let's go and look at the solution to this and see how we go about it. Okay, requirement A, Madrid PSC, determination of market value. We have for 3 years. Don't forget, we are given what? 2015, 2016, 2017, 2018. Isn't it? Now, okay, we were told that 2015, okay, the question is correct, that 2015 should be regarded as the, don't mind the year, that 2015, you know, we are dealing with projection. We are dealing with projection. That is why the question is telling you 2015 is the recent year. So it's actually correct, okay? Because others are projection. So currently we are in 2015, but we are projecting for what? 16, 17, 18. Now, I've told you that whenever you want to carry out valuation, okay, what you should look out for is what? Future cash flows. You need future cash flows. Your current cash flow has nothing to do. It has nothing to do. What you should look forward to is what? Is future cash flow. That is why we are projecting for what? First 3 years, and from year 4 to what? From year 4 to infinity. Okay, if we are projecting for the net profit after tax and preference dividend, profit after tax and preference dividend as given here is what? Look at it. We have a profit after tax and preference dividend. Okay. Profit after tax. Don't forget, preference shareholders are not what? Are not part of the owners of the company. Though we can have participating preference shareholders. That does not mean that all preference shareholders are automatically part of the owner of that company. So ordinarily, preference shares should be regarded as what? More or less like a debt holders. Okay. Therefore, you need, if there is preference share in the question, the profit you need is profit after tax and what? And preference shares. That is what I picked there. Okay. That is what I picked right there. We have 1073. That is for 2015. But I need for what? I need for 2000 and what? For 2016 up to 2018. And that is what is posted right there in that solution. Okay? That's what we have right here. 2016 to 2018. Because 2015 is the current year. Please, I'm repeating it again. I'm repeating it again. Because I know you are going to ask. I will start receiving questions now. Why didn't you include 2015? The reason why I did not include 2015 is what I'm explaining right now. Because 2015 is not a projected cash flow. Okay? It's not part of our okay. What I will need is what? The future cash, and that is cash flow for 2016 to 2018, and for 2019 to what? To infinity. All right. So that's where we now have our what? Non-cash items. What are the non-cash items we have there? Look at them. These are the items I explained earlier. We have provision for them. Have them right there in the income statement under note 2. Look at the material in your hand. You see it there under note 2. We have depreciation right there as well. It has to add because they were initially deducted. Okay, we have lots of sales of sets. They were initially deducted. How do you enter them back? We are done with that. Next one is what? Your working capital. We need to go and set our working capital. Okay. Our working capital. That is work note 1. That is work note 1. Okay. So that's our work note 1. Let me go to the work note 1 now so that we see how you sort your working capital. This is my work note 1. This is my work note 1. Now, you'll be wondering, why did I include 2015 right here, Abby? Now, I'm going to explain to you to be clearer now. Now, when we say working capital, when you want to sort your changes in working capital, we are in working capital from one year to the other. That's what we call changes in working capital. Let me take inventory for instance. Now, if in 2018, for instance, my inventory is 20,000 naira, and in 2019, my inventory has gone to 25,000 naira. What does it mean? It means my inventory has what? Has increased by what? By 5,000. That 5,000 naira is what? Is increase in inventory. And because inventory is part of working capital, I will refer to it as what? Increase in working capital. Are we together? Okay. Now, what I will be comparing is to compare closing balance with what? With opening balance. Don't forget, the opening balance in the current year is the same thing as the closing balance of previous year. Just December 31 and January 1, almost the same thing. The inventory you have in December 31, 12 let me say 11:59 midnight, definitely is that same inventory you are going to carry out to the new year, isn't it? So That is why we are comparing the closing balance for that year with what? With the opening balance for that same year. So that we'll be able to know whether there is increase during the year or a decrease during the year. So that's what I did here. Look at my closing balances. If you look at the statement of financial position, the statement of financial position, now what? These are the figures we have right there as our closing balances. Don't forget, statement of financial position is always at the year end, isn't it? It's always at the year end. So all the figures there, they are at the end of the relevant years stated in that question. All right. Now, these are the opening balance for all these years. Now, I need the opening balances. The opening balances will be that the closing balance of 2015 is the what? Is the opening balance for 2016. That is the reason why I brought in this 2015, so that it will be clear to you. If I just come here, I said closing balance 9,100, opening balance 9,000, you will ask me, from where did I get 9,000? Wouldn't you? You would. You understand? That is why I included 2015, so that it's clear to you. These are the closing balances. And of course, the closing balance for 2015 represents the opening balance for 2016. The closing balance for 2016 represents the opening balance for 2017. The closing balance for 2017 represents the opening balance for 2018. So I can get my what? I can get my, look at this one now. This is the closing balance, 9,900. And the opening balance is what? 9,000. So there is increase of 900. The closing balance is 10,100, while the opening balance is 9,000. There is increase of 200. I will get that. Now, here the opening balance is 10,600, while the closing is 10,600, while the opening balance is 10,100. So there is increase of what? 500. That is what you just go straight and post in that solution. That's what I have right there in the solution. You see there. You see right there in the solution as what? Our working capital. Can you see it? Can you see my working capital? Current asset. Can you see that? Don't forget that we still have one to solve, which is what? Current liabilities. Abi? I've sorted. That's why I label it as what? Work note 1A for current assets. So I do the same thing to current liability. I do the same thing to current liabilities. Now, for our current liabilities, I do the same thing to it. Look at it. That's what we have as a note 1B. Note 1B. Okay. For our note 1B, which is a current liabilities, is what? Look at the statement of financial position. These are what? These are our closing balances. Now, the closing balance, the same argument for what? When we're dealing with current assets, the closing balance here is the opening balance here. The closing balance in 2016 is the opening balance in 2017. The closing balance in 2017 is the opening balance in 2018. So it means here, look at it, this is the closing balance, but this is the opening balance. So what has happened? It means my current liability has increased. Anytime your liability increases, what does it mean? It means more money has come in. You have received more finance. That's what it means. Okay? You have received more finance when your liability increases. So the treatment of liability is the direct opposite of treatment of what? Treatment of asset. Please take note. The treatment of liability, where we are doing your changes in working capital, is the opposite of the treatment when we are dealing with assets. All right. So when you come here, we have 5,564 as the closing balance, and look at it. This is the opening balance here. So there is increment, which is what? Which is an inflow. And likewise here, this is the closing balance, and this is the opening balance. There is increment of 501, which is equally an inflow. So that is what we posted there under what? Under current liability in our solution. All right. Now, we have sorted our non-cash item. We have equally sorted working capital. We have equally sorted working capital. So the next item to be sorted is what? Is our capital expenditure. We need to sort out our capital expenditure. All right. Capital expenditure. Look at it. At the closing of the year, these are the figures. That is the figures we have right there in the statement of financial position. However, may I tell you that the figures you have in the statement of financial position are what? Are net book value. They are after you have what? You have deducted depreciation. Isn't it? And don't forget also that the balance you are bringing from previous year to the next year is also at net book value. Okay, good. We are bringing net book value from previous year. It means when you add a new asset for the current year, you are going to depreciate them together, isn't it? So it means that the depreciation you state in the income statement is the depreciation on the new assets you have acquired in the current accounting period and the depreciation on the asset you are bringing forward from previous year. Are we together? So these two depreciation we need to be added back to what? To your closing figure so that we get what is actually the total what? The total asset we should have in this business without depreciation for that particular year. That is the reason why we have to add back our depreciation to the closing balances. Are we together? That's why I needed to add my depreciation. So when I add my depreciation, I will now go and what? I will now go and compare with my what? With my opening balance. With my opening balance. Okay. Don't forget that the closing balance of 2015 is what? Is the opening balance for 2016. The closing balance for 2016 is the opening balance for 2017. Closing balance for 2017 is the opening balance for what? For 2018. Okay, you will now net them off. Here, I just put this on there. 2015, I don't need it. I just included it here, just for you to understand. Okay, 2016, I will say this, that is the closing balance plus depreciation minus opening balance. That gives me negative 492. It means in 2016, we have capital expenditure. That is the what? The cost. Okay, so this 492 is the asset we bought during 2016. You can see that there is increase and increase. The closing balance plus depreciation is higher than what? Is higher than what we have as our what? As opening balance. So it's going to be an outflow. It means we have spent to acquire more PPE for that particular year. Now, when you come to 2017, the same argument, we have increment of what? 510. Now, let us look at 2018. You must be very careful whenever you are sorting all this thing I'm telling you about, especially capital expenditure. where there is going to be what? We're going to purchase of new asset or disposal. Now, don't put it in your head that the only thing you can ever add is what? Is purchase. If that is what you know, the examiner can try to manipulate your what? Your reasoning. And they just put what? Disposal, just like what we have here now that I want to explain. By the time they put disposal and you are not used to disposal, your system is gone. So look at how you are going to know that there is disposal. Look at it. Now, this is the opening balance. This is the closing balance, right? This is our depreciation. We have added these two together. Okay? When you add that two together, what will it give us? I'm coming, 1 minute. 12,417 plus 400 is giving me 12,870. Can you see that? 12,870. That is the closing balance altogether with depreciation inclusive. Now, but look at the opening balance. The opening balance is higher than 12,870 that you have therein. So what is the implication of that? The implication of that is that during this period, we have what? We have sold an item of PPE. We have sold an item of PPE. Now, the PPE we sold, the carrying amount of that PPE is what is 380. That is 12,070 minus 13,250. That is what is giving us that 380. That is the carrying amount of the PPE we have sold during that period. However, please be cautious. Don't go and post that 380 in your free cash flow. No. It is not necessary that the asset will have been sold for the carrying amount. It can be sold for an amount that is higher than the carrying amount. Also, it can be sold for an amount that is less than what? Than the carrying amount. The value you are interested in is the value at which that asset has been sold, not the carrying amount. However, you can use the carrying amount to get the value at which the asset has been sold. How will you do that? They will have told you in the question or in the additional information to read that, okay, an asset was sold in this particular period, and the profit on the sales of that asset is also so amount. If that is the case, you have to add the profit to the carrying amount to get the sales proceed. So the profit on the sales of that asset plus the carrying amount of the asset is what will give me the sales proceed of that asset. If, however, that asset was disposed at a loss, now the sales proceed is going to be the carrying amount less what? Less loss on disposal. Now, let's go back to that question and check 2018. Let's see what happened there. I think they gave us information regarding that. Let's look at that information. You see what I'm talking about? You see what I'm talking about? Let's look at that information. Okay, we are told that included in what? Included in operating expenses are, we are listed, what I'm interested in is what? Loss on sales of PPE. Now, the reason why I'm not bothered about 2015 because 2015 is not included in my projection. Now, but 2018 is included. And in 2018, I have been told that the asset that was sold in that year was actually sold at a loss of 150,000. Okay, hold that constant, loss of 150,000. Okay, and here note what? Note, okay, note 2, Abi, or 3. Note 2. We're told that the carrying amount of the asset is what? 380. If the carrying amount of an asset is 380 and the asset was sold at a loss of 150, please, what will be the sales proceed of that asset? Do I need to tell you that? No. The sales proceed will be simply what? Will simply be the carrying amount minus the minus what? Minus the loss on disposal. So that is the little calculation I did there. Down there, I said carrying amount. Look at it. Carrying amount 380. Loss on disposal of PPE 150. So this is the sales proceed of that asset. So look at it. This is the I gave a note here. That star represent what? Represent carrying amount of PPE disposed in 2018 at a loss of 150. So this is the sales proceed. The sales proceed is 230. The carrying amount is 250. So the loss on disposal is 150. So I will pick all these. I go and put them in my what? In free cash flow to equity. Okay. We have sorted our capital expenditure. Now, don't forget, what we are calculating is what? Is free cash flow to equity. I mean, we are calculating free cash flow to equity. Therefore, and I've told you, what differentiates free cash flow to firm from free cash flow to equity is interest, issue of debt, and what? That is proceed from issue of debt, and what? And redemption of what? Redemption of debt. Okay. Interest has already been sorted. Forget about that because the profit we pay was what? Profit after tax and preference dividend. Meaning that my interest has what? My interest has already been deducted. Before you get profit after tax, your profit is deducted, Nabi. So interest has already been treated. The next thing that we need to treat now is what? Is whether there is issue of debt for that period or there is what? Redemption of debt. And that is what I have as what? As information note 3. Now, our preference shares, I told you, should also be treated as debt. Don't forget. Whenever you see preference shares, when we are calculating free cash flow, it should equally be treated as debt because preference shares is more of debt than what? Than equity. Even though sometimes it can be regarded as hybrid financial instrument, especially when it has a condition of being converted to what? Ordinary shares. And don't forget, your loan can also have that same characteristics. Are we together? Okay. So I'm treating my what? Note 3A. I'm treating my preference shares. That is 3A. Okay. For preference shares, when you look at the statement of financial position, this is what we have as our closing balances. Now, the closing balance of 800 in 2015 is the opening balance here in 2016. So look at it, 800 closing, 800 opening. So there is no issue of preference share for that year. So our figure is what? Is 0. Now, in 2017, the closing balance in 2016 is the opening balance right there. So we have closing balance of 450 and opening balance of what? 800. What is that telling me? I have what? I have redeemed. I have redeemed 350 worth of preference share. And in 2018, the closing balance in 2017 is the opening balance in 2018. So closing balance 450, opening balance 450, that is 0. So it is only in 2017 that I have redemption of preference shares. So I go and put it right there. I will now come to what? to note 3B, which is our what? Which is our debenture. Please don't go and include current liabilities. Current liability is working capital, and we have already sorted that. Okay. All right. Now, 10% bond or 10% bond. These are the closing balances as stated in the statement of financial position. Now, the closing balance in 2015 of 2,400 is what? Is the opening balance in 2016. Look at it, 2,400 closing balance, 2,400 opening balance. What happened? Zero. There is no issue, there is no redemption in 2016. Now, in 2017, the closing balance of 2016 is the opening balance in 2017. So, closing balance is 3,000, opening balance is 2,400. When you net it off, you have 600. And what is that telling us? We have issued more debts because our closing balance has what? Has rising above the opening balance. So more money has come in. We have issued debt to collect what? To collect funds from the investor. Okay. In 2018, the closing balance in 2017 is what? Is the opening balance right there. So what has happened? Closing balance is 1,500, opening balance is 3,000. So we have redeemed part of our debt obligation. Okay? And how much have we redeemed? 1,500. So these are the figures we are going to put right there. When you do this, let's now go back to that solution there. I've shown you all the workings. Now, show you all the working. These are all what we have been doing all this while. You can see preference shares, bond, and so on and so forth. So when you sort all this, what comes out is what? Is free cash flow to equity. Now there is issue left that we need to solve. What is the issue? We are told that the free cash flow is going to grow from 2019. I think it's 17%. Let me be sure. Yeah. Oh, no, that's dividend. That's for dividend. It's not 70%. Let me see the growth rate of free cash flow. Free cash flow to FEB, okay? Free cash flow to equity is expected to grow from 2019 to infinity by average growth rate in revenue. Okay, good. So we need to compute it. Now you have to go and compute what is going to be the growth rate in what? Growth rate in the free cash flow. And that we are told it should be what? It should be average growth rate in the revenue. This should not be a problem to you any longer. We have done something similar to this when we are doing a dividend valuation model as a means of what? Of computing cost of equity. Where I told you we can calculate growth rate in two ways. That is, when you are given dividend history, historical dividend payment over a series of years, or for what? Dividend, Gordon's growth model. Okay, right here, I'm not using Gordon. Okay, what we have to use is what? Is we are given our historical revenue. Look at it. Over a series of years. So, what is the average growth rate in revenue over this year? How will I get that? I will just say the revenue for 2018 all over revenue for what? For 2015. Raised to power 1/3. Look at it. Revenue has grown from year 2015 to year 2016, 1. From 2016 to 2017, 2. From 2017 to 2018, 3. Not 4, please. Don't go and put 1/4. It's 1/3. That is n minus 1. So I will say 8,140 all over 5,250 raised to power 1 over 3 minus 1 will give me the average growth rate in revenue. And that is what will represent my what? That is what will represent my growth rate in free cash flow from year 2019 to infinity. I think I did the computation right there. Let me see. I think I did it right there. And coming. Let me see if I did it. Oh yes, I did. Look at it there. Look at where I did it. Average growth rate in revenue. LR. LR is no lecture room. For those of you that have been, not even those of you for us that we are coming from higher institution, LR is not lecture room, please. The LR means what? Latest revenue. Latest revenue. Okay, which is what? 2018. Then over what? Earliest revenue, which is 2015 revenue. Raised to power what? This is 1 over n, not ordinary n. 1 over n minus 1. 1 over n. Okay? Now, this is the revenue for 2018, revenue for 2015, raised to power 1 over 3 minus 1. So when we evaluate that, we are going to have 1.157 minus 1, and that is what? Approximately 16%. So I will say my growth rate in free cash flow is what? Is 16. Isn't it? Is 16. Okay. If it is 16, then how will I get my terminal value? How will I get my terminal value? Okay. How will I get my terminal value? Coming. Okay. These are free cash flow. Okay, this to firm. We are in free cash flow to equity. Free cash flow to equity. Okay. Now, from this our 2018 figure. Now, after 2018 figure, we are told that that free cash flow will now grow by what? It will grow by 16% from 2019 to what? To infinity. So what are we doing here? We are doing free cash flow to infinity. However, our infinity will start from when? From 2019. So the first thing I am going to do is to multiply this figure here by 1.16. That is 1 plus G. 1 plus G. Our G is 16%. So it's 1 plus 0.16, which is what? 1.16. So I will say 1.16 times what? Times 1,605. That is the first thing I'm going to do. Obviously, that cannot give you this figure, isn't it? Obviously, it cannot give you that figure. Okay. After you have multiplied this by 1.16, you will now come and what? Discount it to perpetuity. You see what? You see cost of equity. Don't forget, the free cash flow we are dealing with is what? Is free cash flow to equity. So the appropriate cost of capital is what? Is cost of equity, not what? I've been telling you this repeatedly, that always think of what? Like to like. It is only in lower level exam that you will be given cost of capital free of charge always. In SFM, no examiner will do that, except on few occasions. And in a question where you will be given cost of capital for free, it means that question is already a mountain, and the examiner does not want to compile problem for you. Otherwise, you have to go and compute the cost of capital. Okay, now, the cost of capital I need to compute, don't forget, when we are dealing with cash flow to perpetuity, is what? we grow it as the cash flow into bracket 1 plus D over what? That cost of capital minus the growth rate. We did similar thing yesterday in our computation of Adeosun Limited, if you have not forgotten. Okay, I will have to go and compute my cost of equity. Okay, now, when I get my cost of equity, when I multiply this one by 1.16, I will divide it by that cost of equity minus the growth rate. The growth rate is 16%, so it will be this figure here, 1,605 times 1.16 all over cost of equity minus 0.16. 0.16 is the growth rate, don't forget. Therefore, I need to get the cost of equity before I can get this figure here. So, how are we asked to compute our cost of equity? We go back to the question. How are we asked to compute our cost of equity? Are we giving information regarding that? Let me see. Yes, I think we should. Okay. We are given asset beta. Good. Here we are given asset beta of 1.62. We are given yield on government security to a 4.5%, which is our what? Which is our risk-free rate. And we are given market return to be what? 11.5%. Now, I want to ask you a question. Looking at Madrid PSC, is Madrid a GED company or a non-GED company? Obviously, you will tell me it's what? It's a GED company. How do you know it's a GED company? Because I am seeing gearing. I'm seeing debt, 24%. I'm seeing preference shares, 18%. I'm seeing equity, 58%. A question that is a company that is not geared will not have gearing ratio. So the moment you can see gearing ratio, it means the company is geared, meaning that the company is having debt in its capital structure. And a company that is having debt in its capital structure cannot have what? Only asset beta as its total risk for equity. The beta is going to recognize what? Is going to recognize financial risk. Financial risk is the risk associated with what? With how the company is financed. I told you that when the company is all equity finance, that is, the company is financed by only equity, the return that shareholders will require will be that is sufficient enough to compensate shareholders for only business risk, because the risk they are exposed to is only business risk. The business risk is the risk that is associated with what? With the activities carried out by that company. And the business risk is peculiar to a particular industry. The banking industry has its own business risk. Insurance industry has its own business risk. In fact, tuition house industry has its own business risk, or let's say education industry as a whole. Are we together? So if a company is not having debt, the shareholder will only require return to compensate for business risk. Return to compensate for only business risk is what is measured by asset beta. Now, the moment the company introduces debt, the shareholder will say, oh, come, we cannot take only asset beta again, because you are now more risky. The company is now riskier than before. Therefore, you need to compensate us of financial risk. So this beta will increase. This beta here will increase because it's going to now include financial risk. The financial risk and the business risk will now constitute the total beta that can be used to measure shareholders' return for that company that is geared. Now, Because this company is geared, I will not go and compute my cost of equity using 1.62. Because the company is geared, what do I need to do? I will need to go and re-gear the asset better. Please, the only thing you need to do, this is why I always advocate, don't cram my notes. Understand the concept I'm giving to you. Understand the concept I'm giving to you. If you have not understood the concept of project-specific cost of capital, by the time you come to this question, what you will have done is you will have used that 1.62 to compute cost of equity, and you will have been in another world entirely. Okay, so we need to go and re-gear this asset better. And look at what we are going to use to re-gear. We are going to use the gearing ratio. Debt 24, preference shares 18, equity 58. And what is the tax rate? Tax rate, I think, tax rate is 30%. So I go and compute my cost of equity. Let's go straight to our keynote. We have our cost of equity right in there. Okay, cost of equity and WACC. I'm calculating the two together because I'm still going to need WACC. So I want to calculate the two together. Okay, asset beta is 1.62. Because Madrid is geared, I will need to re-gear the asset beta to incorporate what? Financial risk. The combination of financial risk and business risk is measured by what? Equity beta. So to compute my equity beta, it means I want to re-gear the asset beta. And the formula to re-gear is what? Beta of asset plus beta of asset minus beta of debt times market value of debt, 1 minus tax rate over market value of equity. Okay, look at what is happening here now. If this is the only formula you have known, and the question is now including preference shares, how do you treat it? That is why, please, I will always repeat it to you. Concept is what matters. Concept is what matters. Once you know the concept, you can face any type of question. You can face any type of question successfully. At least 80% confidence in you. Okay, now look at what is going to happen here. We have gotten our formula to re-gear Nabi. Now, market value of equity is 58. Market value of debt is 24. Market value of preference shares is 18. While tax rate is 30%. Now, you will see that in the question, I wasn't given beta of debt. What should be my assumption? My assumption should be that I have assumed that the debt of Madrid is risk-free with a beta of 0. That should be the assumption I will state in the question because I wasn't given beta of debt. All right, I will slot this in the formula. This is my beta of asset, the one we have here. This is my beta of asset, the same thing repeated here, minus beta of debt assumed to be 0. Please, I don't want to start receiving calls or messages that why did you use 0 for beta of debt? I'm saying it now. When beta of debt is not given to you in any question, always assume that it is what? It is 0. When beta of debt is not given to you, always assume that it is what? It is 0. So you can jot it down now. Okay. Now, my value of debt is 24, isn't it? 1 minus tax rate. Now look at it. In the formula, do we have preference shares? No, but I'm bringing it in. Why did I? Because I have told you that preference share is more similar to what? To debt. Why didn't I add that 18 to 24 and say 18 plus 24 should be 42, right? Okay. Why did I say 42 1 minus tax rate? The reason being that preference shares dividend is not tax deductible. Okay? Your preference shares cannot in any way save you tax because you don't deduct preference dividend before arriving at profit before tax. It is from profit after tax that you deduct preference dividend. So for that reason, it won't be stated net of tax. That is why I added it as a whole. Are we together? So the principle still remain the same. The only thing now is that because one is tax deductible, I recognize it. The other one is not. I did not recognize it as being tax deductible. So I will evaluate this before adding it to 18. And I will now divide it by what? Market value of equity, which is what? Which is 58. So I will have my beta of equity to be 1.62 plus 1.62 times 24 times 0.7 plus 18 over 58. So I have 1.62 times. When you evaluate this, you have 34.8 over 58. So 1.62 plus 1.62 times 0.6 is what we are going to get when we evaluate that this equation further. And when you evaluate it, you have what? Equity beta of 2.592. I don't need equity beta. What do I need? I need cost of equity. So I will go straight and put it in CAPM formula to get my cost of equity. So I will say cost of equity is equal to my risk-free rate plus beta of equity computed here, market return given in the note minus risk-free rate. And that is what is giving me 23%. Okay. Not, in order not to waste our time, let us also compute our what? Let us compute our WACC because we are still going to use it. Now, we are told that the company will borrow at what? At 452 basis points above risk-free rate. It means that the cost of debt is risk-free rate plus 452 basis points. And I told you, always convert your basis point to what? To percentage. How do you do that? You convert your basis point to percentage by dividing the basis point by 100. So 452 divided by 100 is obviously 4.52. And that is what we have here. 4.52 plus 4.5 is giving me 9.2%. And right in the question, we have been given our cost of preference share to be 9.2%. So I will go straight and compute my WACC. I will compute my WACC. This is formula for WACC. Cost of equity times value of equity plus value over value of equity plus value of preference shares plus value of debt plus cost of preference shares, value of preference shares over value of equity plus value of preference shares plus value of debt plus cost of debt into bracket value of debt all over value of equity plus over value of equity plus value of preference shares plus value of debt. So what is our cost of equity? 23%. What is our value of equity? 58. Now 58 plus 24 plus 18 is what is giving total market value of what? Of the company's capital, which is 100 altogether. So that is why I simply put it as 100. Don't say from where did I get the 100. The 100 is what? That 58 for equity plus 24 for debt plus 18 for preference shares. We give you 100. So I have 23% cost of equity times 58 over 100 plus 11.2 for cost of preference shares over 18 market value of preference shares over 100 plus 9.2 for debt. 9.2 for debt. Please submit. I'm coming. Okay. Let me tell you this. What you should do is that if you look at the cost of debt that we computed there, it's 9.2%. It is pre-tax. There's no doubt about that, because you have computed that cost of debt using risk-free rate and basis point. And the question did not tell you that, assuming that the cost that will come out is what post-tax, except there is specific information to that effect. Otherwise, you assume it is what pre-tax. And you know, when you are computing your work, the cost of debt that you need to use is what? Is post-tax. So I need to go and what? To go and convert that 9.2 to post-tax. And that is why I have my 1 minus tax rate. So I will not say times 24 over 100, not 1,000, is 100. That should be bracket. That 0 should be bracket, not 1,000. Okay, so I have 23 times 0.58, 11.2 times 0.18, 0.644 times 0.24. And everything should give me 60%. So we have computed our work because we are still going to use it. Okay, our cost of equity is 23%. Let's go back to our requirement. Let's go back to our requirement. That's we are A, AB, A. Okay. So what we are actually doing is to get our terminal figure. So our growth rate is what? Our growth rate is 16%, right? Am I right? 16%, I think. So I will have 1,605 over times 1.16 all over cost of equity, which is 23. So 23 is 0.23 minus 0.16. So that is what will give you 26,593. Please let me call it again so that you can jot it down. I said, for me to get this terminal value, that is the year 2019 upward cash flow, is what? This 1,605 times, you know, it's 2018 figure. I need to grow it to 2019. So I will multiply by the growth rate, which is times what? 1.16. I will now say everything there all over cost of equity, the one we computed, which is what? 0.23. So I will say over 0.23 minus the growth rate, which is what? 0.16. When you evaluate that, is what is giving us 26,597. So I will now say discount factor at 23%. I'm using 23 because I'm dealing with free cash flow to equity. So when I'm dealing with free cash flow to equity, what do I need? I need cost of equity. And my cost of equity is 23%. So 23% year 1 is this. 23% year 2 is this. 23% year 3 is this. Now, when we are doing free cash flow to infinity, and the cash flow you grew to the future cash flow is not a year 0 cash flow, it is very, very important that you multiply the figure you have gotten by discount factor of the base year. What am I saying? All this should not be new to you, because I think we have done it over and over again. So if you have gone through all our notes, you should have mastered it by now. If you have not gone through it, it is high time you started going through it. Okay. Now, you know the cash flow we grew is this one. And this is year 2018 cash flow, Abi, is what we grew to this. So it means the base year for this free cash flow is year 2018. So the free cash flow I've gotten here, I need to multiply by the base year discount factor. And the base year discount factor is what? Is 0.537. That is why I'm having is 0.537 here. So when I multiply this by this is when I get all this percent value here. I get this percent value here. So my total equity share value is the addition of all this. And that is what I have here as 17,000 and what? And 72. Now, to get my market price per share, I need to get number of shares. In the statement of financial position, I was told that my total nominal value of shares is 2,000. However, nominal value per share is 25 kobo. 25 kobo is 0.25. So what will be my total number of shares in this company? Is that 2,000 total nominal value all over nominal value per unit? And that is what? 8,000 shares. So I will now divide the total market value of equity by number of equity in issue. That is how I got my 70,072 over 8,000. And I have 2.13. So that is the market price per share of Madrid. You now advise Barcelona that, oh, okay, at least you should pay, you should be ready to pay 2.13 per share for Madrid share. It does not mean that Madrid will sell at 2.13 because Madrid will likely sell at a premium. So the value is going, the selling price is going to be higher than this because a premium is going to be added to it that will serve as a gain to the current shareholders of Madrid. So that is going to be based on negotiation. So the importance of this 2.13 is to guide Barcelona as to from where to start the negotiation and what should be the maximum premium to be added to what to this. So it's just a guide. Are we together? Okay, let us now go to requirement B. Requirement B is telling us to calculate free cash flow to firm. I mean, free cash flow to firm, and determine the market value of equity. Okay, to calculate free cash flow to firm, we have already computed free cash flow to equity. So I don't need to go and start from the beginning again. I will just identify those three items I gave to you. What are the three items? Interest, 1. Issue of debt, 2. Redemption of debt, 3. These are the three items that you will find in free cash flow to equity, but they must not be included in what? Free cash flow to firm. Therefore, to calculate free cash flow to firm from free cash flow to equity, I will go and adjust the free cash flow to equity for these three items. For these three items. Now, that is why you see, I started with what? Free cash flow to firm. I actually gave you the format as format 3. If you look at your material, it is there as format 3. So I'm following that format 3 to solve this question. I'm following format 3. Okay. So that here is my free cash flow to equity. Now I will add back my interest. I will add back my interest. However, the interest I'm going to add back is not going to be the total interest, because if interest is charged to profit or loss, it will save me tax, isn't it? It will save me tax. But if I am not charging it to profit or loss, what happens? I will pay tax on it. Therefore, since I'm derecognizing it, adding it back means that I'm derecognizing it. So the moment I'm derecognizing it, it means my taxable profit will increase. And once my taxable profit increases, what happened to my tax? My tax should also increase. Therefore, what I'm going to do is that I'm going to take the net of the interest. That is 1 minus the tax rate. It means I've already deducted the tax that I'm going to pay. So the actual interest that I'm going to recognize is interest times 1 minus tax rate. So when you go and pick the interest in the question, you multiply by 0.7. This is what we're going to get. Now, we equally have one item again, apart from interest. I intentionally picked this question because of the preference shares, because there has never been any icon question where candidates are asked to compute free cash flow and preference shares is included. Do you understand that? There has never been any question. Okay, let me say I've never seen the icon question of that nature. So it might happen that they decide to come from that angle. So the moment you know from now how to go about it, it will not pose stress to you. Now, don't forget that because free cash flow to the firm is available to equity and debt holders, all returns that is attributable to debt holders must be what? Must be included. That is why we have added back interest. Now, preference share dividend should also be added back because it is also categorized as what? As debt. However, that is not going to be adjusted for interest because it is not tax deductible. Or look at that income statement. Did you see me charge preference shares dividend before I computed my tax? No, I computed my tax before charging preference dividend, isn't it? So preference dividend is not saving me any tax. So I'm not going to take it net of tax, unlike what? Interest, where I treated this net of what? Net of tax. So these are my preference dividend. One item has already been treated. Now, what is the second item? Issue or redemption of loan. Okay, we have this is what we have already done in that what? In that free cash flow to equity that you are what? If you look at this figure there, with okay, this one has already been adjusted from income statement anyway, okay, because we pick profit after tax, okay, profit after tax and preference dividend, okay. Now, if you look at this, for the redemption of debt, we have for issue / redemption of debt, which is a note 3, we have preference shares. We actually what? We actually redeemed. That is why it was outflow. Now, what did I do to it? I added it back because it was initially deducted while calculating free cash flow to equity. Now that I'm calculating the free cash flow to firm, I need to add it back. Now, what about bond? Bond was what? Was initially added because we issue more debt during that period while calculating free cash flow to equity. Now that I'm calculating free cash flow to firm, it needs to be deducted. I'm just doing opposite of what I did to what? To the free cash flow, to the treatment of the item under the free cash flow to equity. That is all. There's no any additional thing I'm doing here. Okay. When you adjust these 3 items, what you get directly is what? Free cash flow to the firm. You can see how simple it is. You get your free cash flow to the firm. Now, because this is free cash flow to the firm, what cost of capital do I need? I need WACC. Because WACC is that cost of capital that is meant for both equity and debt holders as well. So I'm going to discount. Okay, before I go, don't forget, this is from year 1 to 3. And we are told that free cash flow to firm will grow by 4% from year 2019 to infinity. The same thing we did under free cash flow to equity. Now, I will multiply this one by 1.04. I will now divide it by 0.16 minus 0.04. That is divided by cost of capital minus the growth rate. That is what is giving me 28,288. So I will now discount at 16%, year 1, year 2, year 3. So don't forget, discount factor of the base year, the same argument I gave you under free cash flow to equity. So when you do that, you have all this as our present value. So add all the present values together, you get 25,787. That is what is called corporate value. That is what is regarded as corporate value. Don't forget, corporate value is the total market value of the company. That is for both equity and debt holders. That's corporate value. Now, if I want to get market value of equity, I need to deduct market value of debt. This can be done in two ways, depending on the information available to you in that question. If they give you market value of debt as an absolute figure, what do? Just calculate the market value of that debt, deduct it from the total market value, that is the corporate value. The balance is market value of equity. Now, if they've given you gearing, like we have it in this question, we have gearing debt 24, preference shares 18, equity 58. I will simply use the gearing for equity to multiply the total to get the value of equity. As simple as that. So it means the market value of equity is 14,962. So what will be the market value per unit? Is going to be 14,962 over 8,000, please, not 800, 8,000. And that is what is giving me 1.87 per share. 1.87 per share. 1.87 per share. I believe you are getting this. I want to blame. Though I can see about 7 charts. Okay, don't worry. I will take your questions after the class. I'll take your question after the class. Okay. Requirement C. Without wasting our time. Requirement C, where we also use dividend valuation model. Now, these are our profit after tax and preference dividend. And we are told that dividend payout ratio is what? 40%, right? Dividend payout ratio is 40%. If dividend payout ratio is 40%, it means 40% of this will be paid as dividend, 40% of this will be paid as dividend, 40% of this will be paid as dividend. And we are told that our dividend will increase by what? By 17%. So the same argument again, I will increase this by, I'm dealing with dividend. Who has dividend, please? Dividend belongs to ordinary shareholders. Therefore, the cost of capital I need is the cost of equity. This is the principle you need to lead yourself through. This is the principle you need to lead yourself through. Know the type of capital you are dealing with. The way you can identify the type of capital cash flow you are dealing with, then you should know the appropriate cost of capital that is appropriate for that what? For that cash flow. Okay. Now, the same argument here, I will grow this by 70%, that is 906 times 1.17 all over 0.23 minus 0.17. That is what is giving me this. So I now come and discount. Discounting at 23%. 23% year 1 is this. 23% year 2 is this. 23% year 3 is this. Because this figure here, the basis of that figure is from year 2018. So 2018 is our what? Is our base year. I will need to multiply my terminal value here by the discount factor of the base year, which is 0.537. So when I multiply all this, by the discount factor, I get all this. So I will now add all the present value of the dividend together. That is what is giving me 10,843. So that's the total market value of equity. I will now say total market value of equity. To get market value per share, I will say total market value 10,843 all over number of shares in issue, which is 8,000. And that is giving me 1.36 per share. Ladies and gentlemen, this is how to use free cash flow model This is how to use free cash flow model to carry out business valuation. Let me give you this assignment. The assignment I'm going to give you is not to be submitted anyway, but if you have any difficulty in understanding the assignment, you can chat me up. I want you to go and look at the question number 1 for May 2019. Question number 1, May 2019. Okay, please, hold on. I won't give you the assignment now. Because May 2019 question was on merger and acquisition. But the basis of carrying out the evaluation that was used for the merger was on the basis of free cash flow. Okay, so possibly I'm going to treat that question under merger and acquisition. So assignment cancel, don't worry. I'm going to treat that question with you. I will treat it with you when we are doing merger and acquisition. So don't bother yourself for now. Don't bother yourself for now. All right, let me go and see the question I have for today so that I can respond to them appropriately before we call it a day. So we still have one question pending to be solved. It's very important that we solve that question because it's not as direct as all this one, Adeosun and Barcelona, are direct. Why did I call them direct? You are given what? You are given a financial statement. The next one we are going to do, the financial statement we are giving is just extra. So there are more adjustments to be made before we arrive at our figure. In fact, we need to go and compute some set of income statement for 3 years. Okay, in that question. So we are going to solve that by the grace of God. May God spare our lives on Monday, and hopefully we should be able to move to economic value added. Economic value added. Okay, we are moving to economic value added by the grace of God. And after that, we go to merger and acquisition. The moment we finish merger and acquisition, please, we are going to edging straight. We are going to edging straight. Okay, so let me take the question for the day before we go to bed. What? Okay, that's from Dorcas Ogundele. What if we also have loss or profit on disposal in year 2017 as well as 2018? How do we treat it? You treat the one that is for 2017, treat it in 2017. The same way we treated the one for 2018 in 2018. The same way we are going to treat the one that occurred in 2017, you equally treat it in where? In 2017. So there's no two way about it. It's still the same treatment we gave it to in 2018 that we are going to give to 2017 figure as well. Okay, so this is coming from Okechukwu Angel. How did you get the opening balance? 0201. Which one is 0201? How did you get the opening balance on, okay, on 2017, on preference shares? The opening balance is a closing figure for 2016. If you look at the statement of financial position, look at the figure for 2016. Or in the statement of financial position, that figure you have there is closing balance for 2016. That's going to be the opening balance for 2017. So the closing balance for previous year is always the opening balance for current year. Okay? So that is how we got that figure there. Okay. This is coming from Baba Sheye. 2017 interest added back should be 2010 and not 10. And not 10. Okay, let me see your assertion. Let me see what you're trying to say. 2010 interest, 2017 interest. 2017. That should be this, I mean. Okay, by the way, what's our interest for 2017? 2017. Let me see whether there is a mistake there so that we can correct accordingly. Income statement. What is our interest? Interest. Oh, okay. Okay. Yeah, we are right. It should be 210. That is 240 times 0.7. Okay. Yeah. I believe that is an error, but I believe it doesn't affect the solution, just that 2 was omitted from the typing. So I don't think this is what he was talking about. This 2017 figure of 10, there should be 2 before that and 1. It should be 210. However, it's not, I'm very sure, it's not going to affect this. And if it does, just adjust it accordingly. Thank you for that observation. Thank you for the observation. Okay. Next question from, please throw more light on free cash flow of 2010. Do you have free cash flow for 2019? Okay, 2019. Hey. Okay. Ogechukwu, what I'm going to say is that go and study. If you started the class with us, go and look at the formula I gave you. When we started the investment appraiser, we did mathematics of finance, okay, before we commenced that topic. And I told you specifically then that all the mathematics of finance I was treating then, they were not for immediate use, that often you'll be coming across them. And once you fail to understand it, you struggle to what? To solve subsequent questions. So I want to urge you to go and revise that annuity and perpetuity. Okay? When you revise it. However, I'm not saying the question you ask is not right. What I say is go and look at it. Now come back and look at the solution. If at the end of the day, you can't still get it, please come back to me. Can just chat me. I will send you a voice note. Okay, I will send you a voice note regarding that. The only thing you need to know here is that when you are asked to discount a cash flow to perpetuity, all together, when you are asked to discount a cash flow to perpetuity, the cash flow you want to grow to perpetuity, you want to discount to perpetuity, can either be a year 0 cash flow or a cash flow for other years. Okay, if it is a year 0 cash flow and you want to discount it to perpetuity, 2 conditions exist. It's either the cash flow is not growing or the cash flow is growing. If the cash flow is not growing, then you have got what? A constant perpetuity. Okay? If the cash flow you want to discount to perpetuity is not growing, it is called constant perpetuity. What you just do is to pick that cash flow the way it is given to you and discount it using the cost of equity to perpetuity, using the cost of capital to perpetuity. Let me assume that the cash flow is 10 million and my discount rate, my cost of capital is 10%. I will just say 10 million over 0.1. I don't need to do any other thing than that. That is if it is not what? If it is not a growing perpetuity. But if it is a growing perpetuity and that the cash flow given to me is a year 0 cash flow, that is what I mean by year 0 is current cash flow. What you will then need to do is that you will have to grow that cash flow to year one cash flow. Because when we are doing valuation, the relevant cash flow is future cash flow. So what you are going to say is that you will see that cash flow of 10 million, for instance, multiplied by whatever growth rate is given to you. If, for instance, they say you are told that 10 million cash flow will grow by 4%, it means my growth rate is 4%. If my growth rate is 4%, my growth factor is 1 plus G. 1 plus G is the growth rate. So my growth factor will be 1 plus 0.04, which is 1.04. That is my growth factor. I will use my growth factor to multiply that 10 million. It means I have converted it from year 0 cash flow to what? To year 1 cash flow. Now, I need to discount that cash flow that I have converted. Now, I will now say that cash flow all over the cost of equity, which I used in the previous example as 10%, I will now say it will not just be 10% again. It will not be 10% minus 4% because I have got a growth rate now. So it will be that cash flow all over 0.1 minus 0.04. Now, because the cash flow I have grown to year 1 cash flow is a year 0 cash flow, and the discount factor of year 0 is always 1, then it means year 0 is my base year. Are we together? Year 0 is my base year, and discount factor of year 0 is 1. So whatever my discount gave me, I will multiply by 1. That is why you see that most often, if the cash flow is a year 0 cash flow, that times 1 is always ignored because it's still going to give you the same figure. If, however, the cash flow given to you is not a year 0 cash flow that like we have in this situation now, it's year 18 cash flow, a year 2018 cash flow, and we have to grow to perpetuity starting from 2019. So the first thing I will do is that I will grow it using the growth rate, which is 16%. I will grow it by 1.16 to year 2019. I will together. I will say that cash flow for 2018 times 1.16. I will get cash flow for 2019 upward. Now, I need to discount it, Abi. I will now say over the cost of equity in that question is 23%. So I will say is over 0.23. Now, the growth rate is 16%. I will now say minus 0.16. That is what gave me that figure for 2019. Now, I will need to multiply the figure there by discount factor of the base year. Don't forget that my base year is no longer year 0. Abi, my base year is now what? My base year is now 2018. So I need to multiply that figure in 2019 by the discount factor of 2018. And that is what will give me the present value to perpetuity from 2019. Thank you. So if you are still not clear, go through our previous notes on cost on the investment appraisal, the mathematics of finance aspect, then come back to this question. If you are still having any difficulty, then you can still chat me up on WhatsApp. Thank you. Okay. Next question from, okay, I've taken that. I've taken this. Okay, from Chiamaka now, from Chiamaka, sir, how did you get 17,667? Sir, why start from 2016? Abba, this question should not come up again. This question should not come up again. Because I've repeated this several times. I said, whenever you are carrying out valuation, your current figure is not included. Our current figure is current year is 2015. So I need projection. Projection now start from 2016. Please, this concept is very, very key. It's very, very key. Please, make sure you understand it. It's not that you now come to the exam now. They now tell you, oh, carry out valuation. They gave you current figure. You are now including current figure in your calculation. You will be wrong. What you need is future information. You don't need current information when you are carrying out your valuation. Except if current figure is the same thing as future figure. That is what we call the perpetuity there, constant. It means everything is the same thing. Okay, year zero figure is same thing as year one figure, is same thing as year two figure. So I will simply assume that that present figure is what applies to subsequent years. So that is the reason why I did not include 2015, because 2015 is current figure, and the information I need to carry out my valuation is future figures. Okay, from Modupe Ola, okay. So please do recap on corporate what? Did I see where? Did I see this well? Okay, I should recap what? Do recap on corporate value and market value under free cash flow. Okay, now corporate value means total market value of the company as a whole. Now, the company as a whole comprises equity, if there is preference share there, if there is no preference share to you, but majorly, the company as a whole is comprised of what? Equity and debt. I'm taking preference share now as part of my debt. So when they say corporate value, that corporate value is the total market value of equity and debt combined. That's what we call corporate value. Market value of equity and debt combined is what will give us corporate value. So if you want to compute corporate value using free cash flow, the free cash flow we are going to use is free cash flow to the firm. Because free cash flow to the firm is the free cash flow that is available to equity and debt holders. So it is that free cash flow to the firm that you are going to discount using WACC. Look at the link. Corporate value is what? The market value of the company combined, that is both equity and debt holder. So if I want to compute it, I need cash flow that is made for both equity and debt, and that is free cash flow to the firm. And if I want to discount free cash flow to firm, I need cost of capital that is meant for both equity and debt holders, and that is WACC. So I will discount my free cash flow to the firm using WACC in order to get corporate value. If I now want to get market value of equity, I will deduct market value of debt from the market value or from the corporate value. Altogether, from the corporate value. And if what they gave me is gearing ratio, like we have in the question we just solved, just take the percentage that is meant for equity, use it to multiply the corporate value. What comes out is market value of equity. Okay. When calculating WACC, the KD should be 6.44 and not 0.644. The WACC is supposed to be approximately 17%. Won't this, what was the WACC we used? Was it not 70%? What WACC did we use? We said I could remember the cost of that was initially 9.2 Abi, and we multiplied by 1.1 minus tax rate. Our tax, if I could remember, is 30%. So yes, now 6.44. I think we use decimal. Okay. So I don't think there's anything wrong there. I don't think there's anything wrong there. Okay, I understand what I'm saying now. This one was used as 0.644, right? Why the equity was, excuse me, why the equity was used as 23%. Okay, I understand you now. Okay, yeah. You'll be 6.44%, 6.44%. Thank you. Now, current asset, 2016, 990 minus 9,000. But we use 9,900 minus 9,000 is what? Now, which year is having that 9,000, and which one is having the sign there is what is confusing you. The sign there simply means that we have increase. And when do you have increase? You have increase when closing balance is higher than the opening balance. So that will be outflow. So I just use that negative that bracket to indicate outflow. Okay. So don't let that to confuse you. It's just a sign to show that it should be treated as an outflow. So it does not have any mathematical procedure that you should be confused about. I just said that because my closing balance is higher than my opening balance. That's why I indicated using bracket to show that there's increase in the working capital. Okay. Also, Sam, you said to use profit after tax, but we use. I said when there is no profit, when there is no preference shares, then you use profit after tax. And I told you specifically, that is the reason why I brought in this question, because of preference share, because ICANN has not set a question that involves preference share. So in case they decide to set a question that involves preference shares, you should know how to go about it. So if there is preference share, obviously your profit after tax must be adjusted for preference dividend before you use it. So obviously the profit you are going to use should be profit after tax and preference dividend if there is preference shares in the question. Okay. Is it correct to say that dividend cover is equal to free cash flow over dividend payment? No, now. It can't be. How will you say dividend cover is how did you get that? We are looking at how many times our free cash flow be able to pay dividend to our current shareholders. Assuming we are distributing all the cash flows to what? We are distributing all the cash flows to ordinary shareholders. That's what it means. Okay? We are assuming that we are distributing all the free cash flow to equity. We are distributing all. We are not retaining any. We are distributing everything to what? To the ordinary shareholders. So what will be the dividend? So it's free cash flow to equity over number of shares, please. Don't reverse it. Don't take the second approach you have given here, please. So what is the difference between this formula? WACC is equal to KE plus Z plus Z, and what? No difference. The same thing. There's no difference at all. There's no difference. If you apply, that is from Modu Peolabi. If you apply the first one, WACC equals KE, you will see that it's still the same thing as multiplying cost of equity by market value of equity and dividing it by what? Market value of equity and market value of debt, market value of preference shares. So it's not different from what we have in the second formula. Cost of equity times value of equity over value of equity plus value of debt, except we are confused about the value of preference shares, which ordinarily you should not be confused about, because when you have preference shares should be included in the computation of WACC. But if it is how the formula is stated that we are talking about, there is no difference in the two. There is no any difference in the two. You can go and try it, use what we solved there, apply the second formula we have given here, you see that you get absolutely the same figure. Okay, from Okafor, if your mom, sir, please don't be offended. Offended for what? We are learning. I'm not offended. You can ask any question and I will be ready to answer you. Okay, no offense committed by answer. In fact, not asking question is when you will offend me. It's when you are not asking question, is when you will offend me. If you ask question, I know yes, it means you are with me in the class. Okay, so please, to draw you back, how did you get the revenue for? Okay, I will answer you, but not here. Just chat me up on that, okay? Chat me up on that. Now, actually, someone answered that. Though I've explained it several times, I deliberately refuse to give it. I just say, okay. Deliberately, I refuse to give because I have explained it and I expected that, and I told you how you get the, we actually solved that question, only that I told you I did not, the computation of that revenue, I did not type it out. And I was saying it that day that, okay, jot it down in your what? In your jotter. I told you I will get the revenue. And the moment I explained it, I expected everybody to go and what? To go and follow my procedure. But only for me to be hearing, okay, send this, do that. However, because the question is getting much, I can promise you that tomorrow I will compute how I get the revenue and send to the group. Okay, I will definitely send it to the group. Thank you. Okay, by this we have I've been able to attend to all the questions I have for the day. I want to thank you once again for being with me for today's class. I'm going to meet you on Monday, 7 to 9 o'clock by the special grace of Almighty God, where we are going to conclude our free cash flow and move to economic value added. Do have a wonderful night rest. Bye.
Hello, Prof.
Yes, sir.
Can you check your charts in case you miss out some questions?
Okay, sir. Okay, why are we not including short-term loan as part of a working capital? Because it is loan. It is not. When we say short-term loan, anything that is going to be working capital should typically involve to have a 12-month time lag, isn't it? So when we say short-term loan, short-term does not necessarily mean it's going to be 1 year. It can be 2, it can be 3 years. You understand? So that is why it should be treated as a loan rather than working capital. So that's why it should not be included. Okay. Okay, capital expenditure. Capital expenditure. The capital expenditure means the amount of fund you are expending on acquisition of new item of PPE. Okay, the amount you are spending or you are providing for in order to replace, either you are replacing an aging asset or you want to acquire a new fixed asset. That is what is called capital expenditure. Okay, that's what is called capital expenditure. And I told you, for the purpose of free cash flow, if it is an increase, it means you have acquired more, and if it is a decrease, it means you have sold part of your fixed asset. Okay. What if we also have loss or profit on disposal in year? Okay, I've answered that. I've answered that question. I've answered this one as well. I've answered this. Okay, I think I've been able to answer all the questions I have right there. The two I missed out is the one I've just answered. Thank you, my host.
All right, sir. Good night, sir.
Good night, sir.
Thank you very much. All right.